All right, well, good afternoon, investors. Welcome to the first bull session of July 2024. My name is Mark Robertson. I am joined here with my steady, reliable, sometimes intermittent magical mathematician of Mid-Michigan, Ken Kavula.
We're having Comcast doing repairs again in my neighborhood. My home network is very unreliable today, and I'm on a hotspot, which is not proving to be as reliable as I'd like it to be.
Ouch.
So we'll see what happens here, Mark.
Well,
Okay.
what I don't understand is Michigan is a big state, and why is it that the crews are in either your neighborhood or my neighborhood? They seem to take turns.
We've been having really bad network issues for
Yeah.
us here. The streaming on television, sometimes in the evening when a lot of people get on, is so slow. It's not even funny. You press your remote and then you sit there for 30 seconds waiting for it to show up on the streaming, whatever you're doing. So it's there's something going on that they're trying to fix, and I'm not sure what it is.
All right.
Could you stand a momentary telecommunications aside? Our very first house happened to be on not a major road, but a city street in Fenton that we didn't have to pay for the road upgrade, so a big road. We found out because they rebuilt that road that Fenton's 911 system was within the cable bundle that our home system was. And so ever after that, we knew that if we had phone issues, they would get fixed within about 15 to 20 minutes.
Oh, excellent.
We did not post that as a feature of the house when we sold it, but we found out that that has benefits too.
Well, the voice.
Yeah, I can say that what is on my network where my house is the state hospital, which is kind of like the yeah.
That's
and they
really
always make sure that electricity works.
Yeah,
like
you might
well,
be within the
I don't
same
have
block,
a competitor that's coming from the ether. So
if you're in the same power block, when they turn on their generators, it might help you too.
Could be. Well, the other two voices you guys are hearing are Kim Butcher, coming to us from Indiana, and Kim is a longtime member of the investing community and an educator at our national events, etc. And the other voice you heard was Matt Spielman, who was talking about 2 lives ago, pre-Ireland, when he lived in Michigan, and he now resides in Houston. Good afternoon to the both of you.
Good afternoon. When I lived in Michigan the third time.
The third time. That's right. All right. It's a busy slide, but we're basically going to take just a quick peek at all the various portfolios that we spend a lot of time with. One of our main, what would they call it, a flagship funds is the Tin Cup Fund. And that picture is just simply there for the golfers in the audience. A lot of times we put up the old tin cup and talk about Warren Buffett. Those of you that want to believe that the Tin Cup moniker was inspired by that movie and Rene Rousseau, you're welcome to do so.
And here I thought you were going to pass that off as a college photo of you and Wendy, Mark. Okay.
Well, it could be pretty close.
But no, give me a break.
Hey, I could find pictures where I was in that physical.
Wait.
He doesn't believe it. All right. We apparently lost Ken thanks to the electrical symbol up in the upper right. So again, we're going to take a look at all these portfolios, the best small companies, Buttonwood a little bit, the Janke auto bill, utility auto pay demonstration. Of course, roundtables are other major flagship fund. And then I almost always forget about the Bare Naked Million. We'll check in on that and the Manifest 40. Are you back with us yet, Ken?
I'm back with you now.
You're gonna have to behave yourself. Don't touch anything.
I won't. I'm trying not to touch anything at all. So we'll see.
Here's the audience's weekly reminder that Portillo's is not a sponsor of this session, although they should be. Kim continues to work on it. But again, another store opening up in Florida. They seem to like Florida a lot, and Florida seems to like them. So maybe we can do something about that $9.44 stock price at some point. All right, here's your reminder. Every week that we do this, no investment recommendation whatsoever is intended. This is entirely an educational demonstration literally meant to illustrate and demonstrate the philosophies, methods, and techniques of the modern investment club movement as promulgated by the National Association of Investors, now known as Better Investing and or Manifest Investing. We basically follow the teachings of one George Nicholson, who approximately 80 years ago said, you know what, anybody can do this investing thing. I just have to show you the 2 or 3 most important characteristics of every company that you need to keep track of, and you can let the rest of the chaos and noise just keep spinning in the background. Pay attention just to a few key things, and it will serve you well. That's what we will be talking about. If we happen to own a security, we will try to remember to disclose that, but please do your own homework before you make any investment decision. Our 2 email addresses are there at the bottom of the page. Anything you would like to add, sir?
Mark, I didn't hear a word you said because I'm going to try to switch to a different network here. Okay,
You're still
I'll
bumping
be
around.
off for a couple. I'm still bumping around in and out, so I'll be back in a little bit.
All right. Well, Ken just missed a good introduction, but we'll allow for that. All right. Here's our performance perspectives page, but it's completely different today. We are basically checking in on the performance of a few key things that we talk about for just 2024 year to date. So it's performance since December 31st, 2023. And much like you might expect, some of those companies up at the top come straight to you from the Magnificent Seven, and they continue to shine quite a bit. The only portfolio that's in here is really the Tin Cup demonstration portfolio, which is doing okay year to date at 11.5, but it's checking in pretty close to the general stock market, which is 13.1 so far this year. And we just see a little bit more dispersion of the results over such a short period of time. We don't even really think in these type of perspectives or time frames, but it is a fact that year to date, that is the situation that we're faced with. The 10 companies on here, we're going to actually look at the Manifest 40 here in a few minutes, but those are the top 10 most widely followed companies if you see a company name on here. Anything jump off the chart at you, Ken, or Kim, or Matt? And is Ken back with us? Thought I heard him come back.
Oh, there he just popped on. His mic just popped on.
Okay.
Okay, I'm new network here, Mark. Can you hear me? Okay.
I can hear you okay. I think you're
Okay.
good
Well,
for
let's
now.
give it a try and see what happens. Okay. All right.
The one thing that I see on the page that just personifies the frustration that many of us have in the community with CVS Health, it is down 25% year to date versus a market at 13. So you're looking at a pretty impressive or unimpressive performance for the first 6 months of the year. And we continue to, those of us that still hold shares of CVS, hope for that turnaround.
It's hard to put blame directly on them. Rite Aid is bankrupt and Walgreens is no better. And whether you went pure play, retail or vertical integration, it's not a good time to be a pharmacy.
Yeah, and it's very hard for me to understand. We've talked about this before. There's obviously quite a bit of traffic at all of those facilities. How can they not be making money? It's not like they're out killing each other with pricing and stuff. So I don't know. It's weird. So anyhow, that is the year to date on all of these. Here's our quick look at the market as measured by the value line arithmetic average. Those are the green bars. We ended the first half of 2024 right basically on the long-term blue trend line, which has been referred to by Jim Clunan of AAII, the American Association of Investors. He was their chairman. He used to call this type of a regression through a set of data the line of reasonable expectations. So we're kind of at a point where most return forecasts during stock studies are coming in pretty close to that 10% range. Those are the numbers you see on the right. So the average stock is basically fairly valued. There are still some opportunities out there. Let's see how the two techniques, the value line median appreciation projection and the manifest investing return forecast is shown in red here, do track each other.
Mark, just a 30-second math lesson. Twice in the last week, I've answered the question, why is this line not straight to show consistent growth? And I had to remind both questioners that a straight line would graph if we were using a different kind of graphing system. This is a straight old, plain old XY axis like you might have used in 7th or 8th grade, and consistent growth on a graph like this graphs in this curve called a parabola for those of you out there that remember those kind of terms. If we're looking at a different kind of graphing system, which is called logarithmic graphing, then we would get a straight line for consistent growth. But I've got that question twice now in the last 6 days, so I thought it might help just to answer it once in a while, just to make it clear what we're doing.
It's always a good sign. That's usually a new member of the community getting used to how we track growth. I have a couple of those questions also, so that's a good sign for us. All right, here's just a follow-up to the slide we presented last week, which just, at least to me, screams this is how different we are. The graph on the left is a distribution of buy, hold, and sell ratings based on the way that we see the planet, and basically build a target return and then decide whether that's enough based on the core characteristics of the company, including its quality, its stability, and a variety of other things. We also care about companies that have double-digit growth, and we also care about what are general market conditions. Is the average stock at 10% return forecast or 15% return forecast or 20%? It makes a difference how you look at these things. So that's basically a summary of how we see the field of opportunity. As you can see, most of it is in the hold characteristic. On the right, that happens to be the Wall Street ratings on the Value Line Standard Edition stock. So you're talking about 1,400 stocks. And you can see they're much more effervescent and positive. That's all I'm going to say. I mean, I think our perspective on the realm of opportunity is probably better grounded. Can I say that? Can I? Is it okay to say that?
I think so, Mark. I think it also points out that the reluctance of a lot of professional analysts to call an actual sell. They might call it a very weak hold, or they have a lot of other synonyms for buy and hold. But to call it an outright sell, I think they're extremely reluctant to do that. I think that might make things a little bit dicey when they go to talk to the company the next time, if the company doesn't agree with the fact that they think it's a sell. So it's there's some politics involved in this as well, I think.
So absolutely. And Len Douglas had asked the question last week, what does Apple look like? And it actually is not in the top 100. It's just off of the top 100 as ranked by this consensus rating. Again, all we do here is we take and give 2 points for a strong buy, 1 point for a buy, 0 for a hold, -1 for a sell, -2 for a strong sell. And I want to meet this person. I'm going to look up and see who it is, and I want to know what their track record is to be out there against 49 other analysts or whatever the number is, suggesting that Apple is a strong sell. That takes some courage. So we'll find out who that is and then take a closer look at their track record. All right, here's another one that we check in on quarterly. Give some people a headache, but what it basically is a picture of, at least to me, and then I'll hand off to Ken for the mathematics. It's the answer to a couple of questions. First of all, do our stock studies, including the stock selection guide based analysis of companies, work? And how does that compare to what Value Line does? And basically, I think that the two are extremely similar. They're either babies separated at birth or cousins. But again, Value Line does the same thing that we do, only they focus more on cash flow. So what you are basically looking at is the difference between forecasts and then what actually happened 4 years later. And so just with the close here in the last few days, the return forecast 4 years ago back as COVID was just a few months in the running, was about 15%. And it actually came in at closer, that's the actual appreciation, 15% over the last 4 years since the early days of COVID. At the time, the value line low total return forecast was 7.6. So that's worth the 2 points that were just added to the plot. And one last comment or tidbit about this. Basically, as I'm sitting there thinking about what to expect from my stocks in the future, and Ken, I don't think we've ever quite explained it this way before, at least not that I recall recently. This is the low total return forecast. So it's kind of a support or a foundation or a floor underneath. And you can see that most of the time that green shaded area, which is the actual returns, is coming in above it. So when I look at this situation here, if I'm doing some forecasting into what might be expected 4, 5, 6 years out into the future, I'm pretty comfortable with something in that 8 to 10% range for my personal family budget. So I don't think we've ever quite pointed it out in quite that way, but it just shows me that that would be a nice, again, low expectation or a low limit on, with the assets that we're trying to take care of. What are your thoughts, Ken?
Well, my thoughts are that the graph is already quite busy, but I wonder if the data is available to be collected back to 2003 it starts. I wonder if it'd be possible to put that same graph at the high estimate in there and look at the banding that goes on and see what this green graph looks like underneath that banding. I'm pretty certain I know what's happening when the graph consistently falls below the red line, that jumpy red line, and I'm pretty certain I understand what's happening when the graph goes above that red line. I guess what I want to know is, are there a lot of times when the green line, the actual, actually surpasses the top of where value line says the stock, the general stock market should be? My instincts tell me probably not. That value line probably captures the high and the low pretty well.
I would agree.
And I'm not suggesting, Mark, that that's something that you should do. I think that would be a lot of work for a minimal payload. But I think I can begin to visualize what that might look like, and I'm pretty happy with just the low on here, and I'm pretty happy with your suggestion that those two lines that you drew over on the right-hand side there, somewhere between maybe 8 and 12, are probably pretty decent for the sample that we're looking at.
Certainly very feasible. I do think it would be interesting. I probably do have ready access to the data to use the median projection, which would be the midpoint of the range you're talking about, Ken. And I would be willing to bet, in fact, I now have almost an urge to do this, that I'll bet you it lays pretty close on to this green shaded area.
That's what I would expect. Yeah,
I mean,
that's what I would expect.
almost to a frightening level.
And the only places that I would not expect it to happen are these black swan incidents. I mean, the 2008 incident, the COVID, the pandemic incident, those kind of things, I would expect there to be a lot of disruption. But other than that, I would expect the rest of it to act pretty nicely when you put the graphs together. Yep.
Yeah, Arnold Bernard, the creator and founder of Value Line, actually put together a few paragraphs in a chapter about why you're going to get those type of moments and why it's not a perfect predictor, because there's no way to predict those.
Exactly. Yeah.
All right. Well, pressing on again, my interpretation of this is that our approach works. I mean, it's a first cousin to the Value Line methodology, and I mean, you can see the two laying on top of each other right there. That is the median appreciation projection on this chart.
Well,
so.
and Mark, it just goes back to what we talked about at the roundtable, that when the value line low total appreciation moves down to a place that it appears to be right now, and that would be around 5% if I'm reading that number, 5 maybe 6% if I'm reading that number correctly. I think I am. When it moves down there, then that yellow bar, two slides back, if you could go back to that that yellow bar on the left right there gets longer. No, not that one, the one before that you were at, the bar graph.
That one.
That one right there. Yeah, the hold bar gets longer. And when that value line median appreciation potential begins to move up, then that yellow bar gets not as long and the green bar gets longer. Some of the stocks migrate to the green as potential increases, and you can fit all these graphs together, and I think they're basically telling us that the method that we're using will always give us some stocks that we can consider for purchase in our portfolios. There's never a time when we don't have some stocks that we can consider.
Yeah, and I go back to looking at the field of opportunity back even 12, 18 months ago, and you guys are all talking about buying the residential construction companies, and I'm like, yeah, it's at the top of the chart, so everything looks good on our studies, but I can't pull the trigger. The next thing you know, you've got Green Brick Partners, just basically hitting a home run. It's just you got to believe. Same thing holds true for the darn semiconductors. I mean, I can go back and actually show that we had looked at them 2, 3, even 4 years ago and said that's just too much of a favorable forecast for the future. That can't all come home to roost, and it certainly has. So part of the frustrations of
There's a question mark.
believe your work. Yes, go ahead, Matt.
Nick has asked back on that value line chart, just to add some more, where he's of course not looking to time the market at all, but looking where December 24, 25, and 26 lie out. Because it looks like the dates are aligned with the green line and don't end up with the red line going out. What time frame is it predicting?
What is the prediction range?
What is the timing for the prediction of the red line? Like, where is December 24, December 25, December 26?
And then you would just simply add 4 years. So the predictions made in December 24 would be measured as the actuals in 12/28. 4 years later.
Well, but on the line here, so the line here goes out to when? Would go out to June of 2028.
Yes.
And you can count back from there.
Mm-hmm.
It looks like it's predicting a problem sometime around the election season. That would be spooky.
Okay, I guess we'll leave it at that. Although I will point out that the thing I talked about last week, which was borderline political, could have a case where somebody's got 350 electoral votes and still is winning the popular vote. It's happening right now.
Isn't winning, you mean?
Well, no, the person winning the popular vote probably has less than 200 electoral votes when you.
I know that's what you wanted to say, right? Okay.
Yeah. So I don't think it's going to stay that way, obviously, and it's early. All right, here's our groundhog results year to date. Well, actually, not year to date, but since February 2nd, close to year to date, and good stuff.
Mark, before the session started, Margot wanted to know, could you remind her where she can go to look at the particular groundhog portfolios? Could you maybe do that in real time and show her real quickly?
If I can figure out how to get there, we'll do that. Just pull up Manifest Investing, which I will try to do here. Try to blow it up so it's a little bit easier to see. Is that coming across okay, Ken?
Yeah, make it even bigger if you want to. Even bigger. There we go. That's good.
So on the far right-hand side and going down, there's this list of published dashboards. If you click on Groundhog 2024, you will get basically a snapshot of the standings from yesterday, might even be the day before that, but basically this is the snapshot. So if you wanted to see what does Jim Gallagher have, he's our current leader. You can see that he's got this Mama's Creations, which is one of Ken's favorite stocks out there. Culinary, Tesla, Figs. Now there, I didn't know that.
Look at that.
There you go, Matt.
I'm
And
number 2. I found it second. We've looked at this before too. I didn't even notice it.
yeah, so $200,000. It's basically been flat, but kind of interesting. It's got a decent return forecast. Big Lots, the wheels have come off. They're closing stores and they're just having all kinds of operational challenges. So they're down about 75%. Of course, his big winner is this AST Space Mobile. They do not have earnings yet. So they're very hard to cover. Whenever you see one that looks like this with a lot of zeros, apparently we did attempt to cover it, but it's a tough cover. So the fact that this says 0 here for the value, this is just a placebo or a placeholder. It is basically worth about $800,000 in cash, and again, he started with 200, so that's his big winner. So again, just to go back and show from the home page, just look for the published dashboards and click on Groundhog 2024. So let's see what other interesting ones can we look at. Want to see what you pick one, Ken? How about this one, Ken Kavula?
It's working pretty well. This is I put together what I call a barbell. I have some really big ones in there, including NVIDIA, and then I have some really small ones. I don't have anything in the medium size or very little in the medium size at all. I think InMode, Installed Business Products, Sapiens and Globus are small, and then ASML and NVIDIA are very large.
It's working out pretty good for you so far.
Yep, 12th place. That's one of my better performances recently. So I'm very, very pleased with it. Mark, we should say that you can't use this to determine placement because the numbers do not necessarily reflect all the dividends that are being paid.
That's true.
So don't look at that and then say I'm definitely in 4th place, and then look at what Mark puts out every week and you see that you're not in 4th place but you're in 14th place. That's because dividends are not included. They are included when Mark does this particular printout here and shows you these numbers.
And that's simply because somebody else does the work for me. Basically, these are updated real time. They will include splits and dividends continuously, so it's pretty reliable. So good stuff. So again, as Ken was pointing out in the green room before the session, there's quite a few bolded entries here. Those happen to represent investment clubs from all over the country, including a number of frequent contenders, former champions, and good stuff. And Ken, I did look it up. The Mid-Michigan Model Club is the club that tied for the championship with Space Coast.
Great. I think B.I. Baker won the local contest a couple different times. That's what I'm thinking of, I think. Yeah.
Could be. All right, so pressing on. Don't think there's anything else of great merit other than the Graham Steffens monkey did a cliff dive from 67th down to 111th, Ken. So
all right.
Takes the heat off.
Go monkey.
All right, we're going to spend just a few minutes, not in any great level of detail, but taking a look at some of the portfolios. These are year-to-date results for a number of things. I just grabbed a random average investor estimate from either Dalbar or Morningstar or somewhere, but basically projecting that the average investor is in low single digits. But here's the thing that we talk about a fair amount around here, that the value line Wilshire, the value line arithmetic average is lagging the Wilshire this year. There it is in graphical form. Normally, the value line arithmetic average historically and over longer periods of time will lead or beat the Wilshire 5000. So maybe there is some opportunity, certainly languishing. We're going to look at the Manifest 40, but the Manifest 40 are best small companies and Tin Cup all check in at around 10%, including Groundhog Nation. And last but not least, the roundtable has been, as we say, en fuego. on fire, and that actually is what has restored it to a 17% rate of return since inception. So we'll take a look at some of these portfolios. The one on the list is there on the right. Okay.
Mark, I listened to Josh Brown this morning, well, actually late morning, talk about the differences between the S&P 500 and the equal weight S&P 500. And folks, if you've never delved into any of that discussion and never did a little bit of thinking about it, he, in very stark, realistic numbers, showed you the preponderance of gain coming in the S&P 500 from a handful of stocks.
Mm-hmm.
And when you equal weight the index, you get numbers that are very, very different. Those of you that are disappointed that you're not beating the S&P 500, the regular index, like you maybe normally were used to doing or have done in the past, should maybe look to compare what you're doing to the S&P equal weight and see how that's doing with everything that's going on. Because after all, most of us do not have portfolios that are just made up of Microsoft, Nvidia, Tesla, and 2 or 3 other really heavy growers, Alphabet, Apple, Google, those stocks. So if you have a nice, well-rounded, diversified, better investing, manifest investing kind of portfolio, then beating the S&P 500 becomes something extremely difficult to do in the short term right now. And you might take a look at some of the other indexes and compare yourself to what's going on because of this imbalance right now in the market. He doesn't find anything wrong with the imbalance. He says it happens quite frequently in the markets, and the market will sort this out eventually and even things out, balance things out. He made a nice advertisement for why mid caps and small caps should be on your radar right now, why you should be looking at companies like good solid mid caps and good solid small caps, because he saw the future for those kind of companies to be extremely bright. So I don't know if you can get that particular session that he talked about. He must have talked 12, 15 minutes about it. But if you can replay that session that he had this morning, right around noon time, it's very, very interesting and very rewarding to think in a little bit different way about why you might not be beating the S&P 500 this year.
Yeah, I mean, anytime you look at the equally weighted S&P 500, the ticker symbol would be RSP for that, and that's gonna align very closely with this, because the value line arithmetic average is equally weighted over the value line universe of 1,700 companies. So you're going to be closer to that green bar than the gold bar that Ken is describing. And one of the reasons some of these on the right are up closer to the Wilshires that they do have some of those Microsofts and et cetera. We'll take a look at that. All right, here's kind of one of our benchmark funds. This is a fund that was put together many years ago to basically demonstrate what if you took and put the maximum amount that you could in a 401k program and basically pretended that you could buy stocks with it, going all the way back to 1994. And you can see that the balance is trickling up towards 5 million. And it's just an interesting demonstration of looking for high quality companies that are on sale and demonstrating this with the tin cup model portfolio. Here is the current tin cup portfolio, and some real long-term community favorites and blue chips in there, along with a sprinkling of a few others. But you can see that the Alphabet and Amazon are in there. Apple has been in this portfolio in the past, but we're just as likely to lean on a Gentex or a Green Brick Partners, et cetera, along the way. Anything come to mind here, Ken? I see your in mode has crept in there.
Right, except that it's a little bit more aggressive growth than we used to talk about being able to maintain that double your money kind of growth, that 15% growth. We used to talk 11.5, 12, and this growth's at 12.5, and that's with a couple of pretty slow growers in there. Ardelyx is obviously giving us a little bit of overweight at the top of that growth average, and you know, if I were managing this portfolio, there's a couple of stocks that I might take a real serious look at, but there's nothing that I would consider in this particular portfolio at the moment to be something that I would seriously considering jettisoning from the portfolio. I'm looking at the two lowest ones, Alphabet and Regeneron. I'm looking at their growth characteristics, and I'm reminding myself of what Nicholson said about double-digit growth, that you need to be extremely reluctant to move those out of your portfolio. They're just over time, they're going to be much more rewarding in the portfolio than something else that you might choose to replace them with. Now, that doesn't mean you can't find better stocks. If you can find a great double-digit grower that has a par maybe 8 or 10 points higher than the 5% we're looking at right here, maybe it is time to make a replacement. But until you can do that, I don't think you just knee-jerk them out of the portfolio.
No, and in fact, one of the things we do like to demonstrate, we do it with the round table and some of the other portfolios that we actually demonstrate portfolio management principles. In this case, we would challenge Regeneron with its 5.1% return forecast. When you do that and actually dive in and take a closer look at the company, you end up with something like this. You know, you're basically looking at upper single-digit growth rate for the company. And notice that even as I did the update, I think this actually happened live, that some analysts must have upped their number. You get a little bit more PE and a little bit more par under this case. So again, with these type of estimates, you're talking about almost a 7 to 8% par, which again still compares pretty favorably to that projected return on value. So this is nowhere near a screaming sell. And even though it is trading down, it's something you would want to watch as a stock watcher in this company. It's trading down near historical low return forecasts, but still not low enough to trigger it. So it would survive a challenge, in my opinion. This, of course, is the COVID bump. They did supply some stuff for the vaccines back in that time frame that is not there. You could probably leave that year out as you were looking at the longer term picture for the company.
And at the same time, Mark, if we would have been prescient, if we would have really been mind readers and done that challenge back a year and a half or so ago with maybe a Novo Nordisk or a Lilly, we might have come to a different conclusion, you know?
Mm-hmm. Absolutely. All right. Second portfolio, again, not going to spend a lot of time on this because we spend so much time with it on a monthly basis with our roundtables. This is just the reminder that we've got this tracking portfolio out there, which is a collection of selections made by a variety of knights, damsels, and the audience. And it's just really kind of fascinating to watch it over time. And we are managing to beat the market by 5 percentage points. That is the goal that is mentioned here, and is a goal. It's a stretch goal, by the way. Nicholson admitted that it was a stretch goal, but try to beat the market by 5 percentage points or more. And literally with a 17.1 rate of return versus a market at 12 over the last, what is it now, 14 years, we do have that 5 percentage point rate of return. So we do our cyber high fives and move on. But this is a really fascinating demonstration. I'm honored to be a part of it.
Well, and we're lucky enough, Mark, if you go to the next slide, we're lucky enough to include some of the big home run stocks in this portfolio. I mean, we have Microsoft, we have NVIDIA, we have Alphabet, we have Amazon in this portfolio. So, you know, 4 of those stocks give us a pretty good leg up towards at least challenging the growth of the S&P 500 or the Wilshire 5000 at any given time, because our portfolio includes some of those real hefty growers right now. Now, whether there'll be hefty growers going into the future, that's another question. And Mark and I have both promised each other that we have some pruning to do in this portfolio, and we promise when we get a little bit more focused, we will be looking at some pruning going on in the portfolio.
Well, Ken, you know what makes me sad?
That you didn't buy more Costco 10 years ago.
Okay, that too, but rolling out of bed and seeing Ardelyx at 550 this morning, because that's last night's.
Oh my goodness! Oh my goodness!
So that minus 28% to start the day. I'm not in a good mood, everybody.
Well, folks, here's a great reason why I don't buy quality stocks with a quality of 20. Okay, and EPS stability of 0.
I'm gonna skip the lesson here. I think they have. At least I think they have earnings now.
Okay.
All right.
All right. That's one thing.
Well, speaking of companies that Ken is more likely to love, here's the Manifest 40. It's the 40 most widely followed companies by the number of appearances on subscriber dashboards. That's as simple as it can get. These are the 40 highest ones. United Health, thanks to some of the stuff that we've been talking about here lately, and I can't explain Southwest Airlines, but they have jumped back into the group. We lost Tesla, by the way, from the top 40. So Tesla, if you're a Tesla fan, make a couple dashboards and drive it back on the list. But of interest here, I mean, this goes all the way back to September 2005. So you can see some charter members of this group going all the way back. And I think, I didn't leave the number of years on there. So you have to go with the 9/20, September 30th, 2005 is when this was started. So back in that time frame, I believe either Stryker or Microsoft was the top company. Apple joined the list about 4 years later and climbed very rapidly up the list. Most recently, NVIDIA and PayPal have been among the climbers. Most recently, NVIDIA. And NVIDIA's been doing pretty well over the last couple of years. You can see that it was only added to the list a little over a year ago. But from top to bottom, these are generally companies that have not only revenues, but earnings and fairly decent quality from top to bottom. And an interesting thing to look at in terms of what are our current community favorites.
I'll tell you the one that surprises me by not being on the list, Mark, is the reluctance that a lot of our groups have about dealing with Meta. META. I don't see it anywhere on this list, which means that it's not on that many portfolios in the Manifest system. And yet it's one of the top performing stocks in the stock market for the last 4 or 5 years. Even though it's had some terrible downtimes, it's really performed extremely well if you look at a long-term perspective. So I don't know where Meta would be. Do you know where it is on the list, Mark, by any chance?
I'd have to actually look it up. I think a lot of it came from the switch from Facebook to Meta, where they changed tickers and basically blew it away on a bunch of dashboards. But you're right, it has not ever climbed back up. And I don't know, maybe there's a few people out there like my spouse and I, we just don't care for the company so much. So there's a lot of that happened after the congressional testimony.
Well, and we're also watching some former really strong favorites in the community just gradually move from the top 5 or 6 down into the bottom 5 or 6 or 7 or 8. They're going to be moving off the list fairly quickly. I mean, and I think the poster child for that is Walgreens. Every time I look at this list, it seems that Walgreens has slipped another 2 or 3 places down the list. It used to be one of the darlings at convention. I began my convention talking career by being on a panel that discussed, would you rather own CVS or Walgreens? And today, if I were on that same panel, I might answer neither. So
yeah, it's definitely a changing environment. Walgreens just recently announced that they're going to basically behave like CVS. So I don't know, adding the in-house clinics and all that kind of stuff. So I
Well, no,
don't know.
they're moving away from it. They're divesting of the ownership of the clinics. It didn't say recently if they're actually going to close any, but they're taking a step away from that.
You know, and CVS has never really expanded it out at the rate that I think most of us expected either.
Well,
You know,
the other company on this list, Mark, that I think was owned by so many people in our community was the little blue pill people, Pfizer. I mean, we had them at investors fairs. They were a big draw. Whenever you said Pfizer was going to speak, you could count on getting a big draw of audience to come and listen to them. And here they are sitting at 39th, down from 38th, and probably moving off this list as we continue to look at really big pharma and wondering what's happening with really big pharma. Does it have the same mojo that it had in the 90s and the early part of this century? I don't know.
okay, so that is the Manifest 40. So we do keep track of that. And again, very briefly, here is a quick update on our best small companies. Again, these run from Halloween to Halloween, so we've got a few more months of runtime. I do not wish to what do we call it, jinx them in any way, but this is a pretty healthy list. What are your thoughts, Ken?
Well, anytime you can have 17 out of 20 in the green as far as total return is concerned, you have a pretty good list going, Mark. That's all I'm going to say.
Yeah, it's a pretty list for sure. Hold on, I seem to be having a little difficulty with the computer. I think maybe some of your lumpy electricity found its way down to our area. Let me try a little tweak here. There we go. All right, next portfolio. One of our favorites for demonstration purposes. This is in honor of Ken Janke and his urging his father back into the stock market with a very simple demonstration. That was, Dad, what if I take your money, go out and buy you a few utilities such that you never have to make another monthly payment as long as you live? And he did that. So we basically tried to emulate this going back to May 2021, purchased 5 utilities, and one of them got sold out from underneath of us. But we've also been experimenting with this JEPI, which is a hybrid of covered calls and enhanced yield vehicle. And we've been just doing that for the educational experience. But the bottom line here is just like it says on the far right there. Basically keep that checkbook balance, the ink, black. And coming along pretty well. You can see that this basically lays out the budget or the expectations for the second quarter of 2024, and then of course the budget for the second half of 2024. And a pretty healthy situation. So it's one of my favorite demonstrations. We will probably expand this a little bit and just demonstrate how this stuff can work in a very favorable way. What do you think, Ken?
I love this demonstration, Mark, and folks, if you don't understand the difference between the yellow background and the white background, the white background's happened and the yellow background is forecast. That's all the difference is.
Yeah, down here at the bottom.
I'm seeing some people with a question about that. It's a real easy thing. It'll go white as the time moves to the end of the year, and this is projected, and it's projected for us to have an $825 surplus in the checkbook by the end of the year. That's nice.
Yeah, and so I mean,
Mark,
go ahead.
I want to make a suggestion that maybe you look at FIW.
F is in Frank.
F is in Frank.
FIW.
Yeah, it's a ETF of water stocks, because I can guarantee you the only thing I'm seeing happen in southern Indiana is water bill keeps going up.
FIW. That's a new one for me, so I'll take a look at that. Is that a First Trust product? Do you know?
I think so, yeah.
Okay, then I will take a look at it.
That was one of the ones that came over from my mom.
Okay. Yeah, I was actually looking at possibly doing a challenge, Ken, to the, one of the 4 utilities, and I'm wondering if essential utilities might actually come up as slightly vulnerable to a challenge. We'll take a look at that at a future session.
Okay,
Well,
Mark, we're getting a question from Nick, and he wants to know, why did you adjust the June utility payment and lower it by 6.6%?
Because whatever index we used actually went down.
Okay.
Believe it or not, it's one of those. It's a fact. We use one of the published utility monthly cost, residential electric cost indices, and it actually went down year over year.
And these are indices for the state of Michigan or for the United States, or what are they for, Mark?
I'd have to look it up. I don't remember what it was.
Okay.
I think it was a larger swath of the United States.
Okay. All right.
But it also, it defies logic. But of all the things that have decreased in price a little bit from their peak levels, look at the price of gas. We were brushing up against $5 a gallon here in Michigan, and now it's down approaching $3, and that would have great impact on utility pricing. Okay, here's a look at another portfolio that we put together a little over a year ago, and this one's kind of fascinating. It's again just here for purposes of keeping track. From top to bottom, we picked a bunch of companies in the electric utility for the most part, but utility in general, infrastructure. And in fact, you just heard Kim mention FIW. That probably is a first cousin to this GRID, which is a first trust fund, exchange traded fund, basically. And First Trust does some good work. But from top to bottom, interesting companies kind of crossing the whole gamut of from trinkets to wires to dams to who knows what. And General Electric is one of the top performers. And it was kind of interesting at the time that we made that selection because GE, Siemens, Honeywell, and a number of the majors are actually performing quite well. A couple of the more experimental companies down at the bottom, or maybe companies that have depended quite a bit on the subsidies, which have been a little bit slow. They slowed down for a while, but they do appear to be coming back at the bottom performance level. But pretty hard to argue with 17 over here for the average performance also. And I don't know if has there been any graphene news to report of late, Ken? Or Matt?
I've been doing some research, Mark, on small SMRs. These are small
Modular reactors?
Modular reactors. Thank you.
Sure.
I drew a blank completely. Okay. And in doing that research, I've come across some ideas with graphene, which are helping in some of the parts for some of these things. But I'm not seeing any particular companies that are doing specific graphene work, just as I'm having a hard time finding specific companies that are public, that are investable for these SMRs. We'll talk about this at a future bull session as my research continues, but I find it extremely interesting if the promise, if the hype behind these things has any truth to it. We might be looking at something that's going to revolutionize power in the next couple of years.
Yeah, and in fact, go ahead, Matt.
I was just going to say, I came across something. It's further out, both in a commercial sense and in a physical sense. But China just returned a probe from the far side of the moon, and among the surprising minerals they discovered was some graphene. So there's a thought that, if we were looking to establish a long-term or permanent presence on the moon, we would need to somehow depend much more on the minerals there than to try and truck everything there. But if something as complex as that might exist. There might be a lot else that exists that we don't always know from Apollo.
So this is in addition to your deep sea treasure hunting for minerals.
Yes. Yeah, exploration.
Exploration. Good stuff. Yeah. In fact, you want to talk about the coulda, woulda, shoulda pile a little bit? I want to say 18 months ago, I could go back and listen to the transcripts or whatever, but Herb Lemcool suggested uranium about 18 months ago. And again, one of those we just kind of shrugged and didn't pay enough attention to it. And take a look at the performance of some of the uranium companies and uranium funds and how much they've basically been red hot. And no pun intended, of course. Uranium. Probably should be a uranium on this list to go with your small modular reactors, Ken.
Could very well. What led me to these SMRs, Mark, was an advertisement on television by Whitney Tilson. He's a well-known hedge fund investor. He is a big self-promoter, but he's the chief investment officer now for a newsletter, and he's trying to sell his newsletter. It's Stansberry's Investment Advisory Service newsletter. And what I found out in listening to this advertisement, which intrigued me, was that Bill Gates is doing a completely self-funded demonstration of these small modular reactors out in the Utah, Colorado area somewhere, and having some pretty interesting results coming from it. He seems to be extremely committed to the concept of portable nuclear reactors. And the other thing that I was reminded of is while people have been taught to fear nuclear energy, we very quietly outfitted almost our entire Navy with nuclear powered ships. The big ships especially, and we've had virtually no problems with these smaller nuclear reactors on these ships that go all over the world and have been workhorses now for decades, not years, but decades.
Yeah.
So the
potential.
propaganda around nuclear power has been real and has been very, very heavily weighted towards the negative, getting people to the point where they're actually afraid of nuclear energy. And maybe we have to rethink that whole concept if we're going to really truly want to be energy free.
Yeah, and one of the aspects of that, maybe we should do an entire session on the companies that are involved in that type of stuff. But Michael Schellenberger does a lot of work in this area. And one of the other features of these small reactors is that they can be designed to consume nuclear waste. And one of the real legitimate concerns with the nuclear power industry was the storage and disposal of the nuclear wastes. And that becomes a fuel in some of these breeder reactors. And
absolutely.
A lot of potential.
And they can be used to retrofit existing coal-powered plants. You don't have to necessarily go out and build a whole new huge plant for the whole thing. You can use these SMRs to retrofit an existing coal power plant. And I've been coming up with graphics with maps that show these coal power plants all over the country that are being mothballed, that are being retired and then mothballed, and that could be used to generate significant amounts of power, So very interesting research, very, very interesting.
As you may recall, it was a subject, or at least a related subject, during our Life After Google sessions a few years ago.
Absolutely.
That I got to go back and read the book again. There's just so many things that have been coming around. Here's just a quick tip of the hat to GE. General Electric, between their medical or health care unit and their power unit and now their aerospace, the three pieces definitely add up to more than three, probably closer to five. We should probably do something to celebrate that at some future session, Ken. But this is just a recent article making that point. We covered it after the first spinoff, and it's interesting to see what the sum of the pieces actually added up to, at least at this so far.
Well, when I say my prayers at night, Mark, I thank my dad constantly for leaving me a couple thousand shares of the original GE stock. It was certainly cut by a lot when they did a reverse 10-for-1 split, but there was still enough to give me some shares in the GE healthcare and the GE aerospace when they spun them off.
Well, there you go.
And Dad, thank you. Thank you again, Dad. Okay.
Well, if you're going to bring Dad into it, well, let's talk about my dad. My dad wanted to talk about
All
GE
right.
about monthly because it was in his
I
IRA.
know.
It was definitely the F on the report card for sure. Um, so we talked about it a lot. So I'm going to give him credit. Whatever he's doing up there is definitely turning the corner for GE.
Maybe he met my dad up there who worked for GE for about 35 years, you know? Okay.
Could be a team effort. Who knows?
Yeah.
And having a brother-in-law who retired from GE just a few months ago, so it runs in the family, and I'm actually alumnus. Anyhow, here is the next portfolio. We'll just cover these real quickly. 2048 Club. Again, we were looking 25 years out. This was done with a contribution from Kevin Galogli, but we basically tried to pick a bunch of companies, or actually a fairly select set of companies that we thought had very long-term, strong characteristics. Again, we're only a little ways into it, coming up on a year, and it's doing okay, but it is not outperforming its benchmark target fund competitor, which after a year checks in at almost 18%, and this is closer to 5 or 6 based on this number. But I think that there's some pretty good companies on that list. A couple of them have turned out to be experiencing operational challenges of a significant magnitude. How's that?
Nice job. Let's go to the next slide.
All right, here's one we don't talk about very much, but this is actually a personal favorite. I have used this so many times with people who don't believe, and this is the genesis. The genesis of this fund was a phone call received around Christmas Day, 2006, of a gentleman, an actual subscriber, said, "What would you do with $1 million? Where specifically would you put it?" And on New Year's Eve 2006, we basically picked the Vanguard Growth Fund for about half of it, and then 6 or 7 industry leaders that had high quality and decent characteristics. And again, that was 17 and a half years ago. There have been, I believe, 5 transactions in this demonstration. You can see that the 1 million is now 8 million. And it just shows how powerful a couple extra points of return are. That's 12.8% return. And this one just, I have used this to actually almost not remove people from consciousness that have struggled with investing. Because when you think about how, the notion of picking these companies, look at some of those added dates. Those are all in the double digits when it comes to years held. And with so few transactions, it just shows you what is possible. Having said that, I am getting an itchy finger with these 3 at the bottom. And if somebody were to send me a much better idea for a fund or a stock, I would consider consolidating them out based on our recent consulting industry study and the frustrations. It's down to $20,000 for Walgreen. So
Yeah.
might be worth investing that $400,000 somewhere else just for the hell of it.
I know you have a fascination and an affection for the Motley Fool folks, but we might make that a 4th one if we're going to look at this portfolio, Mark, and ask ourselves if we couldn't do better with a different small cap fund as well.
That's a legitimate challenge too. I do have a lot of faith in them. Their Motley Fool 100 has actually done much better. But I was very hopeful, but it's just a demonstration again of how badly some of those small growth companies have done over the last few years too.
Sandy's giving you 3 ideas right now, Mark. You can jot them down.
Okay, what are they?
Nike, Palantir, and Amazon. Okay.
Ooh, I like that. Might have to scratch my head over that. But I've got a lot of people sending me notes and they wouldn't buy Nike products anymore, so we'll see. All right, so
All right.
all right, I think we're going to close with Buttonwood. Yeah, this is our last one. Again, we have kind of reached our target number of companies with the cash in the portfolio. We'll be adding one more company. Our primary design driver for this is to have enough growth. That's based on what seems to be more successful collectively out there. So we do want to end up in the mid-teens for a growth rate, and we're there now. We just want to make sure that we end up there. We will be challenging one of these or two, but this will become a real-time living demonstration of portfolio management. And so far on the hot seat, probably would be Thermo Fisher Sciences, Scientific, with this a little bit lower par and a little bit lower growth rate. And we're getting a little frustrated with people not drinking adult beverages. So I'm not sure Diageo would survive, but we certainly would take a look. What are you thinking, Ken?
Where would you like to go with the last thing? Do you wanna? I hardly ever look at a sector map or an industry map, except I don't want to go in twice in the same industry, something really closely related.
Mm-hmm.
Where would you like to go with that last purchase, though? Any ideas where generally you might like to take a look? Do we need more tech in this portfolio yet, you think?
Well, I was thinking we sell like half of them and put it all in Luminar and just go for broke. Just kidding. Just kidding. I only do that with.
Wait to see. Actually, look what happened with Rivian, right? Rivian got essentially bridge funding from an industry investor and had a great day. So when that happens for Luminar, then we can maybe have a small celebration of alcoholic beverages.
Sounds good.
I think we have enough Luminar in the portfolio, Mark. Okay.
Yes.
I have no preconceived notions. I say best available player, and just try to find who that is and whether or not it conflicts with anything already in the portfolio. And yes, Kevin Gologli, I still hold Western Alliance for real. So he's always worried about.
Do we have a financial company in the mix here? We have Visa, which is
Western
sort
Alliance.
of financial.
Western Alliance.
Oh, we have Western Alliance. Okay, well we don't need a bank then, do we? Okay, all right. So I'm gonna make it a mission, Mark, to look for something for Buttonwood and send you some names. Okay.
Best available player.
All right.
All right. Here's just a quick reminder that we do archive all of these sessions on YouTube under the Manifest Investing channel. That includes our roundtables, which are our monthly webcasts where we go through the discovery and analysis of 4 or 5 companies on a monthly basis. And all of the bull sessions are here. And then every once in a while, we'll actually have a special educational session. And by the way, Ken, I'm getting so many requests for us to continue to develop the Prove series, the projected return on value. We're going to need another workshop.
Okay, and I'm getting a lot of requests to continue the the beginning ideas that we put together for last time. So we'll have to. My chapter is meeting to decide what the program is going to be for this coming year, and maybe we have to put in at least one more set of classes and maybe 2 sets of classes as we move forward.
Yeah, I think those are always good. So that's good.
Yeah, they are.
And here's a reminder that we will tackle the subject of buybacks in quite a significantly deeper dive than usual, and show the impact on studies and just tackle the subject in general. I think we answered that Ken French is a distinguished professor at some major university as to who he is, but Meb Faber's bio is there on the right. Just a fascinating guy to listen to. He's got an excellent podcast and some stuff. All right, so in celebration of the fireworks, that was the fireworks above White Lake, Michigan, here a few days ago. No, I'm kidding. I'm pretty sure that's Sydney, Australia. Is that correct?
Yeah, well, That's the Opera House, so I think that's probably Sydney. Yeah.
So in celebration of that, again, we'll wish everybody out there a safe and festive Independence Day celebration here. The stock market is closed tomorrow, so you all have the day off. And be safe out there. Anything else in the hopper, Ken?
No, nothing except wishing everybody a good afternoon and have a great 4th. Be safe, be careful. If you're going to use Roman candles, they say that over 2,000 people went to the hospital last year because of Roman candles in particular. So be safe, folks.
Yeah, absolutely. And if that's not exciting enough, find the next Netflix and go along for the ride.
And send the name to us.
Yeah, maybe Luminar is our next Netflix, Ken. Let's
Okay,
see
I
what
hope
happens.
so.
But I don't want to
Goodbye,
wake. I don't
everybody.
want to wake up in the morning down 28% on issues. All right.
Bye-bye, everybody.
Take care, everybody.
Bye-bye.